Ever wonder who really pulls the strings in the insurance industry? Most people assume it's federal regulators, but when it comes to property and casualty insurance, it's actually the state regulators who hold the most power. In fact, the entire U.S. insurance regulatory system is built around state-level authority, and that has major implications for how policies are priced, approved, and enforced. Let's break this down. Unlike banks or securities firms, which are primarily overseen by federal agencies like the FDIC or SEC, insurance is regulated almost entirely at the state level. Why? Because of a landmark law passed back in 1945, the McCarran-Ferguson Act. This law gave states the explicit authority to regulate insurance without interference from the federal government, unless Congress specifically says otherwise. So, whether you're in Florida, California, or Illinois, your insurance market operates under state-specific rules. What does this mean in practice? For starters, state insurance departments control whether an insurance company can operate in that state. They approve or deny rate filings, policy forms, and even insurer financials. If an insurer wants to change pricing or add a new coverage form, it must go through the regulatory process in each state individually. Let's take an example. Say an insurer wants to raise homeowners' insurance rates due to increased wildfire risk. That insurer must file justification with the state regulator, often including data on loss trends, exposure concentration, reinsurance costs, and more. In some states, like California, those filings may be heavily scrutinized or even rejected. In others, like Texas, they might be accepted more quickly. Now compare that to what the federal government does. The federal role in P&C insurance is relatively narrow. Agencies like FEMA, HUD, or the Treasury may influence certain areas like flood insurance or terrorism reinsurance backstops, but they don't set pricing, approve products, or supervise day-to-day carrier operations. That's all state territory. So why does this matter? Because the state-by-state patchwork makes the insurance market both decentralized and diverse. What's allowed in one state may be banned in another. Pricing can vary dramatically due to local regulation, and carriers must navigate 50 different compliance frameworks, which adds complexity, but also reflects the unique risk environments across states. But it's not just about regulation. State regulators also play a key role in consumer protection, enforcing rules on claims handling, policy cancellations, and market conduct. They're the ones consumers call when things go wrong, and they have the authority to discipline carriers, issue fines, or even revoke licenses. So while federal regulators may oversee systemic risk or backstop certain programs, it's the state regulators who make the real day-to-day decisions that shape how insurance is sold, priced, and managed in your state. Looking ahead, this decentralized model likely isn't going anywhere. While there's always debate about federal involvement, especially during natural disasters or financial crises, the state-led system has proven resilient for over 75 years. Want to learn more about how regulation shapes your insurance policy? Like this video, subscribe to Insur Knowledge, and drop a comment with your biggest question about how insurance actually works. We turn complicated insurance topics into real-world insights, and we've got more videos coming soon.